Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, September 12th, just after the close. What are we going to discuss today? Market's been fairly steady, right? There's been a little volatility day to day, but there is a bid there on any pullback. So we like to see that. That'll change at some point. We're not sure when. By the way, nobody's sure when. So let's take a look at some of the analytics we use at Cumberland to try to identify where we want to be positioned. Keep in mind, news flow will always be there. It has always been there. Now today, with the multifaceted ways we receive news, markets can react and overreact and underreact a little bit quicker and perhaps at extremes. But if you're just following news flow, it's difficult to position properly. What we like to do on the equity side, first of all, is try to identify, are we in a risk-on or risk-off market? In other words, should we be positioned in our equity allocation aggressively, or should we be playing defense within our equity exposure? So the chart that I'm going to share with you, and Christopher's putting up there, is a relative strength chart. You hear me use that term often. Relative strength is just how does one asset class or sector do, or how is it doing versus another? Is it outperforming or underperforming? It's nothing more involved than that as far as a definition goes. But how you use that information can be very helpful. So when we look at this chart, we're looking at the equal weighted discretionary index versus the equal weighted staples index. So RSPD for discretionary, RSPS for staples. And we're trying to identify, do we want to be overweight risk versus be overweighting defense? Staples are a defensive area where you try to protect capital while still being active in the equity market. When we're in a column of X's, that is showing strength. When we're in a column of O's, that is showing weakness. This is a point and figure chart. Very, very effective at identifying price changes. Note that there's no volume involved here and very little week to week, month to month dates. You'll look along the top ribbon. Those are years. So and they're reflected on the bottom ribbon as well. This is just identifying, do we want to be aggressive or defensive in our equity positioning? So we are currently on a risk-on mode or posture right now. What's that benefiting within our portfolio? So let's look at tactical trend. What's working well within that portfolio? Well, broadly speaking, the NASDAQ 100, QQQ. Even to the point where the equal weighted technology, RSPD, broadly speaking, acting very, very well, making new highs. On the individual side, we're seeing continued follow through on almost any aggressive name we put in the portfolio. That will change, but it hasn't changed yet. So Microsoft continues to work well. Lam Research had a very nice week, up 7-8%. AppLovin, the stock we discussed when we put it on, 3 months ago, and it's exploded since then. You can even look back to a name like GE Vernova that did so well for us and had some volatility this week. I wouldn't be surprised at some point in the future we don't go back to that name. Those are risk-on names. What are some names within tactical trend that struggle a bit in a risk-on atmosphere? Well, the one that should come right to the forefront is Berkshire Hathaway, right? We own Berkshire Hathaway in tactical. It's been a wonderful long-term holding. But since April into May, it's had difficulty getting a wind at its back because it's a little bit more of a defensive name. So I just wanted to cover how we try to take a look at relative strength from a risk on versus risk off. We will see a point in the future when that column reverses to O's, similar to how it did in April, and we perhaps have to take our foot off the gas. Notice, if Chris puts that chart back up, notice that over the last few years, the pullbacks from in this chart, in other words, when we shift into O's, which means staples are outperforming discretionary, right? O's are defensive on this chart. Notice, even though there has been some back and forth, each time we've seen higher lows in the chart, showing that each movement in staples has been a little weaker than the previous one. So we're just talking about some second and third level thinking, something away from, hey, what did Oracle do? We know Oracle had a great week. What did Lam Research do? What did Microsoft do? Let's take a step back and say, what is the market trying to share with us in terms of our positioning? So I hope this was helpful. Happy to have further conversations with our clients or even with viewers that may want to get more information on this. The Moose is with you on a good, solid fixed income week. Let's see what John has to say.
Hi, it's John Musa. I'm the Chief Investment Officer at Cumberland Advisors. It is Friday afternoon on September 12th. This is the bond report. Before we start, a couple of things. We mourn the turmoil and the senseless killing that was out there with Charlie Kirk being murdered. Whatever your political persuasions, there's no room for this kind of violence in this country, and we hope that the country adopts a better tone where you can have more civil discourse. Whether that happens or not, we don't know. The other thing was, of course, September 11th, observed yesterday, 24 years. Doesn't seem like 24 years, but those of us who have been in the business a long time remember it like it was yesterday. We all lost a lot of friends that day, and it's just as painful today thinking about it. And God bless all their souls, and may they rest in peace. This week in bonds, yields down. More in munis and treasuries, a little bit of that in a minute. But you can see that the treasury yield is down from a 408 to a 406 in the 10-year, 9 basis points in the long bond, 476 to a 467. Continuing this trend, because remember, just a couple weeks ago, we hit 5% in the long bond. So there's definitely been a pretty decent move there. A couple of reasons why. Really, on the inflation side this week, good numbers on the PPI. Came in at minus 0.1 when the expectation was to be 0.3. And when you look at the CPI, that came in at 0.4 when they were expecting 0.3, a touch higher. But even that was offset yesterday by the fact that you saw initial jobless claims come in a lot higher than thought. Expectations were 235, it came in at 267. We have a graph here showing you initial jobless claims going back to the beginning of the year. Clearly, you can see how it's picked up. And when you look at that, it's not surprising when you start to think of not only the government workers who have come off of benefits, they're feeding into that. And now you're starting to hear more companies. We heard ConocoPhillips going to lay off between 20 and 25% of their workforce. Now, that doesn't happen overnight. It happens over time. But the tenor has changed. And one of the ways you can tell the tenor has changed is in this second graph, which shows you the University of Michigan Sentiment Index. The Sentiment Index has 3 parts to it. How respondents feel about their own personal well-being, how they see the economy in the short term, and how they see the economy in the long term. And it all feeds into basically one index. And you can see it peaking last November, right after the election, at around 75, 77 in there. And you're down basically to the mid-50s now. That is a pretty good drop, basically over 10 months. And, there's no question that things like tariffs, things like immigration, they all lead to uncertainty. And when you have uncertainty, businesses have a hard time planning and investing. And, that I think is what some of the part that's going on here, as you've seen this drop in interest rates lately, because economic activity has just been slowing down. So on the muni side, you did see yields come down, particularly on the long end, 443 down, and that's down about came down about 20 basis points this week to 423. That's a pretty big move. And the 10-year AAA scale also came in and went under 3%, went from basically a 309 to a 290. That's also a big move. Some of that is the fact that you have had pretty good inflows into bond funds, over $2 billion this week. So clearly investors have now shook off all the concerns about munis, tax talk back in the spring, volatility that hurt munis, and then, of course, the huge supply bulge that we had at the end of July when the July coupon payment had already been spent. That's behind us. We expect to have slower supply as we go forward to the end of the year. So the fourth quarter, which is usually a pretty good time for the muni market, is giving expectations that it should be that this year.
Thanks, Moose. Everyone have a great weekend. We'll see you next week.